let's just jump right in. Investing can seriously feel like you're trying to drink from a fire hose. You've got PE ratios, dividend yields, beta, historical returns. It's just this constant flood of data. And you're left wondering, how on earth do you compare an exciting tech stock to, say, a boring old utility bond without your brain just completely shutting down?
Well, the truth is, you need a map. You need a way to cut through all that noise and see the whole picture at once. And today, we're going to break down one of the most powerful and honestly underused tools in finance, the scatter plot. This is the thing that turns all that data chaos into actual, usable clarity.
So here's the game plan. First, we'll tackle the data problem head on. Then we'll define our map. I'll show you how to build your own, we'll walk through a real-world example, and then we'll land on the big takeaway.
All right, section 1. Let's get right into the heart of the matter, because looking at investments with just one data point isn't just incomplete, it's dangerous.
This slide right here says it all. If you're just looking at a list of returns, stock A looks incredible, right? A 20% return. You'd think you were a genius. But a list is one-dimensional. It completely hides the other side of the story. Now, when you put that same exact stock on a map, our scatter plot, the truth comes out. Yeah, you got that 20% return, but look at the cost. You had to endure a terrifying roller coaster of risk to get it, a ride so wild it might have made you panic and sell at the absolute worst time.
So let's properly define this risk-reward map, this tool that really does turn chaos into clarity.
Okay, so here's the professional textbook definition. A scatter plot is a two-dimensional chart. In the world of finance, the vertical axis, the y-axis, is almost always a return. That's the reward. And the horizontal x-axis represents risk, which we usually measure by volatility. So every single dot you see on this chart, that's one single investment.
So, how do you actually do this? Let's move from theory to practice, because this is a tool you can genuinely use yourself. It's really just 3 simple steps. First, you choose your players. What are you comparing? A couple of tech stocks, major asset classes like stocks and bonds? Step 2, you gather the data. You need 2 numbers, the annualized return for the vertical axis and the standard deviation, that's our proxy for risk, for the horizontal axis. And you can find this stuff for free on sites like Morningstar or Yahoo Finance. And finally, step 3, you just plot the dots and start analyzing what you see. And analyzing it is actually pretty straightforward. The top left quadrant, that's the holy grail. High return, low risk. Doesn't get any better, but these are pretty rare. The bottom right, that's the danger zone. You're taking on a ton of risk for a pathetic return. You want to avoid that quadrant like the plague. And what you're really looking for is something called the efficient frontier. It's basically a line that connects all the investments that give you the absolute best possible return for any given amount of risk you're willing to take.
Okay, enough theory. Let's look at a real-world example to make this super concrete. We're going to wind the clock back to the decade from 2010 to 2020. This was a massive bull market, right? Mostly fueled by super low interest rates and the explosive growth of big tech. So let's see what story the map tells us.
So here's our blank canvas. We've got risk on the horizontal axis and return on the vertical. We're going to plot 4 major asset classes, one by one, and just watch as the data reveals the story of that decade. First up, let's plot U.S. bonds. And no surprise here, it lands right in the bottom left quadrant. Super low risk, around 3%, but also a pretty low return of about 3.5%. This is our baseline. It's boring, but it's safe. Okay, next, let's add international stocks. Now, wait a second. Look at this. To own these, you had to take on way more risk, all the way out at 15% volatility, but your return for that specific decade, only about 5.5%. Given the slower economic recovery in other parts of the world back then, that turned out to be a really bad deal. A lot of risk for not a lot of reward. And this is where the map starts to scream at you. We add U.S. stocks, the S&P 500. Now, look closely. They actually had less risk than international stocks, about 13%, but delivered a massive 13.5% annual return. That is a far, far superior trade-off, pushing right up towards that holy grail zone. And finally, of course, the tech sector. It was the highest risk on the chart, around 17%, but it also delivered absolutely incredible returns of 19%. This completed chart instantly tells the story of that decade. But, and this is so important, this map is just a snapshot in time. In a different market, say a global recession, this map could look completely different. Bonds might be the quiet star, and high-risk tech could be deep in that danger zone.
The map changes with the market. So after all that, what's the big takeaway? How do you actually use this map to get an edge in your own investing?
It all comes down to this. Scatter plots do not predict the future. Let's be clear, nothing can. But they are the absolute best tool we have for understanding the playing field right now and for making sure you aren't accidentally taking on Ferrari-level risk for what turns out to be a junk car-level return. So here's your homework. Pick 2 investments you own or 2 that you follow. Find their long-term return and risk data and just plot them. That simple act of creating 2 dots is your first step from guessing to actually knowing.
So that brings us to our question for you. Have you ever actually used a scatter plot to look at your own portfolio?
Let us know in the comments below. And don't forget to subscribe to Market Fluency for your daily edge.